We're back to explore another dimension of the market simulation. Today, we're diving into what I believe is the single most powerful edge any trader can develop: understanding and capitalizing on market psychology. Think about it. Behind every price movement, every chart pattern, every market cycle, there are human emotions driving the action. Fear and greed, the twin engines of market movement. The fascinating thing about market psychology is that it's predictable. Human emotion follows patterns that repeat across decades, markets, and asset classes. Once you recognize these patterns, you can position yourself to profit from them. Let's start with fear. Fear in the market manifests as panic selling, overreaction to news, and irrational price declines. You see it in the VIX spiking, in put option volume exploding, in mainstream financial media turning apocalyptic. When genuine fear grips the market, assets get mispriced. Companies with strong fundamentals get dragged down alongside weaker ones. This creates asymmetric opportunities, situations where your potential reward far outweighs your risk. Warren Buffett famously said to the market, "Be fearful when others are greedy, and greedy when others are fearful." But executing this strategy requires something that most traders lack: emotional discipline. The ability to counter your instincts to buy when everything is in your body is screaming danger. On the flip side, we have greed. Greed shows up as euphoria, as FOMO, fear of missing out, as irrational exuberance. You see it in skyrocketing valuations, in retail investors piling into speculative assets, and taxi drivers giving stock tips. The late stages of bull markets are driven almost entirely by greed. Fundamentals get ignored. This time is different, becomes the mantra. Prices disconnect from reality as the collective delusion takes hold. For the disciplined trader, these periods offer shorting opportunities, or, at minimum, a chance to trim positions and build cash reserves for the inevitable correction. But here's where it gets interesting. Market psychology doesn't just operate at the macro level of bull and bear markets. It creates exploitable patterns at every time frame, from monthly cycles down to intraday movements. Consider the psychology behind support and resistance levels. These aren't magical prices where some market deity decides stocks should reverse. They're psychological barriers created by collective human behavior. Support forms when enough market participants believe a price is cheap and start buying. Resistance forms when enough believe a price is expensive and start selling. When these levels break, it triggers a cascade of stops and new positions entries, creating the breakouts and breakdowns we trade. Market psychology even explains why technical analysis works at all. Moving averages, chart patterns, Fibonacci levels, these tools work because enough people believe they work, creating a self-fulfilling prophecy. The objective reality of a company doesn't change when its stock breaks down a trend line. But trader behavior does, and that's what moves price. Let me share a personal example. During the March 2020 COVID crash, fear was palpable. Markets were in free fall. But looking at companies like Google, Amazon, and Microsoft, it was clear the market was irrationally pricing them as if their businesses would be permanently crippled. This was pure emotion, fear detaching price from value. I recognized the pattern and bought heavily when others were panic selling. Within months, these positions doubled as rationality returned to the market. This wasn't about having better information. Everyone had the same information. It was about recognizing the psychological pattern and having the discipline to act counter to the prevailing emotion. So how do you develop this edge? First, study the market history, crashes, bubbles. These patterns repeat. Understanding how previous cycles played out gives you context for recognizing current ones. Second, practice self-awareness. Your own emotions are your greatest enemy in trading. Learn to recognize when fear or greed is influencing your decisions. Third, develop a trading system that accounts for psychology. Use sentiment indicators like put-call ratios, the VIX, or consumer confidence surveys as part of your analysis. Fourth, Keep a trading journal that tracks not just your positions but your emotions when entering and exiting trades. Look for patterns where emotion led to poor decisions. Finally, remember that the market is ultimately a human creation, a game within our larger social game. The rules of human psychology apply here just as they do everywhere else. Those who master market psychology don't just understand charts and fundamentals, they understand human nature. And in a market driven by collective human behavior, that's the ultimate edge. In our next video, we'll explore specific technical patterns that reveal psychological traps in the market and how to profit from them. Until then, stay disciplined and remember, in the game within the game, emotional control is your greatest weapon.